Let me bring on board as Nagnath, President and Chief Investment Officer with DSP BlackRock Investment Managers. Nagnath, always a delight to have you back on ET Now. Good morning. Thank you for joining us.
Thank you.
How would you characterize the current market environment, Nagnath? We are up 16% already for this year. At these levels, are markets now looking fairly priced?
Well, if you look at the price earnings multiple based on the estimates for fiscal 12 and fiscal 13, I mean, we're still trading below the long-term trend P multiple of about 15.5 times thereabouts. So we're more like 14 times or so. So in that sense, we're not expensive, we're not cheap, we're tending towards fair value. And I think, as you pointed out earlier, liquidity continues to remain reasonably good. We've done very well since the start of the year. But looking ahead, I think we have to be watchful for two risks. One is, of course, the continued rise in oil prices since the beginning of the year, which is of some concern on account of, geopolitical tensions in the Middle East. And the second is the possibility that there could be some renewed concerns about the Eurozone crisis again coming up in focus sometime during the middle of the year or so.
Nagnath, whereas you flagged off concerns, which is oil and EU, let me also talk about the third joker, which is China. And China is now threatening to slow down. Do you think that is good news for commodities, that is good news for crude, and that is good news for India?
Well, there are some analysts who do talk about a slowdown in growth in China. I'm not entirely clear as to when it will happen. It's not very clear this time. But if that should happen, certainly that will have a dampening effect on commodity prices. I'm not so sure about crude, because crude is marching to a different tune altogether, which is geopolitical tensions in the Middle East. But yes, other commodity prices could soften, and that could be beneficial to countries around the world that import a lot of commodities.
Nagnath, you just talked about oil being a very big risk, and considering the geopolitical tensions in the Middle East right now, and them, rather the sensitivity that crude has to those regions, if we were to escalate another 20-30% in terms of crude from the current juncture, say to 150, do you think the market can reverse its trend and we can also stare at December lows? Because then the RBI is also going to reposition itself by way of interest rates.
Yeah, that's a possibility. I mean, certainly if crude were to get to $150 or $160, as you point out, certainly markets around the world will be in a risk aversion mode. That applies to equities globally, and it will apply equally to equities in Asia and India. So that, could take the markets down, 15%, 20%, depending on the severity of the up move in crude prices. So that's a distinct possibility. But at the same time, I think, these spike in crude prices, as we've seen in the past, are not long-lasting. They probably last, a few days, a few weeks, because if it is a very long-lasting move, then obviously it will damage the growth in the world economy quite significantly. So after that spike, I think crude prices then correct significantly, and that will be beneficial again for equity sentiment around the world, including in India.
Nagnath, if I look at FY13 Bloomberg estimates, by and large everybody is talking about a muted growth. Do you think earnings, they have potential to surprise us on the upside? Because if RBI indeed, if they start cutting rates, we could see a margin expansion, growth coming back, revenue expansion.
Yeah, two things. I think as far as interest rates are concerned, we believe the first of the rate cuts will happen in April. And then after that, the trajectory of rate cuts will depend upon how inflation, trends in the months thereafter. And in terms of earnings estimates, again, I think given that we've had a somewhat choppy market in the last 12 months or so, analysts obviously have been somewhat more cautious in their estimates. As things improve, in the second half of the year, I do think that earnings estimates also will progressively get upgraded. We believe, for example, that while consumption will remain more or less steady in terms of its growth, the capex cycle, which has been somewhat subdued in the last 2 years, will begin to pick up steam, and that could well add quite nicely to GDP growth. So earnings estimate, I would argue, by the time we get to the fourth quarter of this calendar year, could be somewhat higher than what we are looking at for fiscal 13, and that will again underpin strong stock market performance later this year into next year.
Nagnath, just to stretch that point forward, if yields were to remain at 8.5 or a little beyond that level, and all things remaining status quo with crude, inflation, as well as Europe, what's the kind of headroom that equities could see from the current levels?
Well, assuming for a moment that these risks that I mentioned earlier, do not manifest, then I think we could be looking at a market that could go up about 15 to 20% from here by the time we get to the first quarter of next year. That would be my assessment at this time.
And that the fixed income products or FMPs, they're still offering you about 10% risk-free. If you're talking about indicative returns of 10 to 12%, is one better off investing in FMPs?
Well, again, it all depends on the individual investor's risk appetite. In the instruments you mentioned earlier, I mean, there could be, an interesting return likely, but at the same time, if you have the appetite for equities, you're going to consider equities opportunistically during the course of this year. So it's not correct to say this or that. If you're a conservative investor, obviously you'll go for more fixed income investments. If you have the appetite for risk, you're going to watch opportunities to buy equities at attractive levels in the coming months and benefit, as I said, from a potential increase in growth rate for the economy and for earnings upgrades as we think likely later this year into next year.
So, Nagnat, we may twist, we may turn, we may get tossed back in a range for next 2 or 3 months, but directionally, do you think this market is headed higher and eventually it makes sense to buy this market on every dip?
I agree with that. I think, the next 3 to 4 months could be somewhat interesting in the sense that we will see higher volatility globally. We do think oil prices will remain elevated for some time. And until those tensions recede, higher oil prices will weigh on equity sentiment globally, including in Asia and in India. And the second is, as I said, we need to be reasonably certain that the crisis in the Eurozone has been fully addressed. At the moment, I think it's been temporarily addressed. It could resurface in some other country that has higher fiscal deficit or debt rescheduling issues, etc. So if those are conclusively addressed, then I think in the second half of this year, you could see markets around the world, including here, trending up quite nicely.
So, Nagnat, how would you approach individual sectors, and especially, given the context of the outcome of the union budget this time around?
Yeah.
Two spaces, banks as well as infrastructure.
Yeah, I think banks, are clearly a large component of benchmark indices and therefore form, reasonably significant weightages in individual diversified equity portfolios. Again, any opportunity to buy them when the sector is trending softly in terms of price action would be a great buying opportunity in my opinion, because later this year into next year, as the economy picks up momentum, growth momentum, and as the markets pick up growth momentum, I think banks will do very well in my opinion. Infrastructure and capital goods, like I mentioned earlier, we are reasonably optimistic that the capex cycle, which has been subdued in the last 2 years, again will pick up growth momentum as we get into the second half of this year into next year. And therefore, we do think there will be considerable investor attention focused on that segment of the market.
So how do you play infrastructure? Because infrastructure by definition is a very large group. You've got builders, you've got asset owners, you've got capital good companies, you've got machinery makers.
Well, you're right. I mean, there are lots of segments in the infrastructure capital goods space. And I think, one would be looking at companies that have finished their projects or are nearing completion, or where there is, financial closure has been achieved. So that, you're looking at essentially projects that are currently commissioned or nearing completion, or suppliers to large infrastructure projects in terms of capital goods, etc., or engineering services. I mean, those are the kinds of segments within the infrastructure space that one would tend to look at.
If I analyze your portfolio, at least for your major equity schemes, my compliment to you and your team, HUL was a great pick which worked for you till December. So what is your clear big contra bet at DSP BlackRock for the rest of the year now?
Well, we can't talk about individual stocks, but being defensive at a time when the market was somewhat volatile did help. But as we move ahead, as there are more opportunities visible in terms of other sectors which have been somewhat underrepresented, I think one will take a look at those, and possibly the focus on the defensives will diminish to that extent.
But are you a bit surprised with the price action in defensives? Titan at an all-time high, HUL nearing an all-time high, ITC nearing at an all-time high. Visibly, defensives and consumption stocks are expensive, but the price action is suggesting something else.
Well, maybe, there is a segment of investors who still believe that it pays to be defensive in the coming months, especially at a time when you have elevated oil prices, and are anticipating, some degree of a pullback in the markets. Maybe that is the reason why, this segment continues to attract buying, would be my view this time.
But you don't believe in defensives now?
No, I mean, at a time when the market is volatile, you need to have some element of your portfolio in defensives. All I'm saying is, as we progress through the year, the volatility recedes, and infrastructure capital goods, as an example, begins to come back into focus, then I think investors will lighten up on defensives and then move some of the money into those sectors. That's what I'm saying.
Nagna, that's a difficult call to take, really, but how do you see liquidity shaping up in the next 1 month or so, 2 months or so? Because up until the next earnings season, it's a lull period by way of news flow.
You're talking of inflows in terms of FI flows?
That's right.
I think it should be fine. I mean, we've seen a reasonable amount of money come in so far this year. We believe that trend will continue unless there is some major risk that looms on the horizon right away. But, otherwise I'm confident that this year, we've already seen, if I'm not mistaken, about close to about $7.5 billion or so. I mean, this year could well shape up to be, one of those years where you end up with about $12 to $15 billion in terms of net FI flows. So it will come. I mean, investors still are very, very optimistic about the growth prospects for India. The consumption story has been well established, and I think that will continue. If CapEx cycle picks up, it will only add that much more to the overall growth picture, and I think that will make India a very interesting investment destination for investors.
Rangnath, have you analyzed the profile of inflows this year for India? Because yes, on a net basis, we've got about $8.5 billion. But if I look at the other end of the spectrum, some of the long marquee names are selling out. Citi has sold out their stake in HDFC, Temasek has sold out their stake in ICICI Bank, and UBS has sold out their stake in Kotak Mahindra Bank. Now, these are long-term investors who have sold out this year.
Well, I don't think you can draw any conclusion from that. I mean, there are more than 2,000 investors, FI investors, who are registered to invest in India, and there are all kinds of investors, endowments, pension funds, long-only funds, etc. So it's quite possible that one or more choose to profit or take profit in their long-term investments. But equally, we are seeing a lot many more new investors coming to India, and this will continue. So I think the actions of one or more investors selling some stake need not lead us to believe that the flows will slow down. I'm very optimistic that inflows into India will continue to remain robust in this year.